Hello, everyone. It's the Bill and Wendy Show, and we're doing a little housekeeping before we get started, and apparently while we're getting started.
Yeah.
So our focus today is as the housing market is cooling down a little bit, people aren't, in a lot of markets, people aren't having to overbid
teaser
to get stuff in, and our rent's lagging. So we've got a great special guest.
Awesome.
And we're going to secretly not tell you who it is until we're done with this long-winded teaser. So right after this. Hi, everyone.
Bill still has not conquered the fact that a teaser is supposed to be like a teaser, like short and quick, and
Here's the thing. I grew up in a family with Wendy involved. There's 5 kids, and once you started talking, you had to keep going, or you wouldn't get another chance.
And Billy, being the oldest, he's the best at it.
So thank you for joining us on the Passive Accredited Investor Show. We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you're interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell. And don't forget to sign up for Wednesdays with Wendy.
Ooh. My favorite little guy.
After those impressive graphics, Wendy donates 30 minutes per caller.
Yes.
On Wednesdays. So she'll do a little Zoom connection with you. Free to anybody that wants to sign up.
Mm-hmm.
It's there's the link. It'll also be in the chat. We also have, by the way, she's booked out a couple of months in advance. So
we talk about real estate
and
Jesus. So either those 2 topics are great.
We have a chat section to the right side or underneath, depending on the platform that you're viewing us from. So please, if you have any questions for us or our guests, please do so. Yay, I made it through.
He did. I'm so proud.
So our theme this week is, as the market's cooling down slightly,
what's going on?
Are rents keeping up with that pace? Are they lagging or are they increasing? And who better than to chime in on this subject than Tim Bratz? He has, I'm telling you, Tim, you are everywhere. Every time I turn my email on, I have an email from you, either for coaching or investing. Anyway, welcome to the show.
I'm surprised he's looking at emails.
Yeah. I got a great team in place, right? So I appreciate you guys. Thanks for having me here. Excited to be here with you.
And not only is it my business email, but you're also coming in on my personal email as well. So your team researched
omnipresent.
Well, apparently.
I told my marketing team yesterday, I say, I want to be omnipresent. I want everywhere everybody looks, they see us. And no, it's well, thanks for not unsubscribing. So I appreciate that, first of all. And we actually try not to send too many emails, but we do about 2 a week. And we try to add some value, and at the same time, let people know we're buying, we're selling, we're joint venturing, we're raising money, we're doing all these different kinds of things. We do some coaching and stuff too, obviously. So I think I think it's important for people to know that there's better returns, as you guys know, in real estate, backed by hard assets, tangible. You got especially if it's an equity investment, it's there's depreciation and all sorts of other stuff that can benefit them that they can't get in the stock market and other traditional type of investment.
Tell us a little bit about what you do and how you got started in this business, kind of just a precursor to our incredible conversation that's about to happen.
Yeah, I mean, high level is I was going through college, 03 to 07. So the market was going crazy. Everybody's making money in real estate. And that was what motivated me back then. So I graduated from college in 07, moved out to New York City. I'm from Cleveland, Ohio originally. I live in Charleston, South Carolina, not far from you guys now.
Neighbors.
And and I got it. I thought you got involved in real estate by becoming a real estate agent. So I got my real estate license. I started brokering actually commercial retail leases and office leases, and just saw how much money there was on the investment side versus on the ownership side versus the brokering side. So I ended up saying I want to become an investor, and I moved down to Charleston, South Carolina. Just wanted some better weather, and got all excited and was ready to invest, and the market collapsed like in late 2008. And I was like, where's everybody going? Run from real estate. And I was like, I just showed up. And so, I was kind of fortunate because market, the prices had dropped. Everything was bottom of the, very different than today, like essentially opposite, right? Like there's a lot of capital out there, but there's not a lot of low hanging fruit type of deals, right? And back 10, 12 years ago, there were deals everywhere, right? You couldn't walk down the street without walking past 3 foreclosed houses, bank-owned homes, selling for pennies on the dollar, but money was nowhere. And I learned very quickly, and after seeing multiple market cycles over the past 12 plus years that I've been investing, you got to be always sourcing capital and always sourcing deals all the time. And so that's, we're focusing on those revenue generating activities. And when I had that awareness, I started meeting people with money, started pairing that up with deals and getting involved somehow. Sometimes I'd lend or I'd borrow money as more of a debt loan, and then other times as like an equity joint venture type partnership, and built up a portfolio. There's a lot of highs and lows and stuff. I can go into the story if you want to, but essentially fast forward to today, I have a portfolio of, I was up to 4,800 doors. I just sold off about 800 of like the smaller properties and some more like the C-class type properties. So I'm at about 4,000 doors right now, but I've transacted many thousands more than that. But my portfolio is a little over $400 million as I sit here today with you.
Wow, that's amazing.
Now, is the majority of that portfolio in the multifamily arena?
Yep, 90% of it's multifamily. I got about 10% of miscellaneous, some office, like small micro office type stuff. I have some storage facilities. I have some vacation rentals and kind of like unique short-term rental type stuff. But yeah, 90% of it's multifamily. And usually in secondary, tertiary type markets. I don't do anything luxury, and I don't do anything that's in war zones. So I stick to that kind of B class, blue collar, workforce housing, rents average.
Affordable housing.
What's that?
Affordable housing.
Affordable, right? Not low end, not like low income housing, but affordable housing for the workforce. Probably rents that range from low end $600 up to about $1,500 a month. So we probably average $800 to $1,000 a month in rent. So right in the middle of the road. I think it's very insulated. When the market's good, everybody can afford that. When the market shifts, a lot of those luxury renters move into more of a workforce. So it stays pretty occupied.
I was going to say the same thing. That's the perfect sweet spot. If you're going to have people moving up the economic ladder, you have people moving down the economic ladder. It doesn't matter. You're still right there in the middle to capture all of them.
Yeah, that's beautiful.
I wanted to kind of back up when you first started to speak about how you saw that real estate really was the best investment out there. And on our show earlier today, we were talking about the current administration. They are trying to tax you on your unrealized gains in the stock market right now. And people don't understand what interim taxation does to your wealth building.
Oh, put a chart together and look at that. You would be like the same way that compound interest benefits you, that hurts you, like inhibits you. I mean, it just takes your legs out. You can't even build wealth that way.
Right.
It's amazing. And I was looking for charts, but I think it's a Google conspiracy, because when I Googled it to have a chart, they're nowhere to be found, because they don't want you to know about it. They don't want you to know how it's ruining your wealth building capabilities. But still within real estate, you are having gains over time without interim taxation. And at the same time, you can throw in cash flow in it. and then tax benefits as well.
Tim, I'm curious, you sold 800 doors. Talk a little bit about your reasoning for doing that.
Yeah, absolutely. Great question. I would say, I'd say it's probably a few different things. First was I had some partners, joint venture partners, who were kind of like the operating boots on the ground, who weren't totally getting the job done. And it just got to a point, they had too much stuff, too many balls in the air, and I knew they were going to drop some of them. I said, hey, let's clear some things out. So that was not really market driven, just more of a, relationship driven. I had to make that decision.
Gotcha.
And then I kind of, I think it's really important. It's why we're in masterminds, and is to go and work on the business instead of in the business, and really reflect on your business and what have you done and where do you want to be going, and kind of create the roadmap, right? Like, we don't know where we're going if we don't have a destination of where we want to go to. And then you got to think about where you are right now, and then you can reverse engineer the map in order to get there. And I was doing some of that earlier part of this year and realizing that a lot of the smaller properties and the C-class properties that got me to where I am, they were stepping stones to set me up for buying 100-unit plus B-class apartments today. Before, though, I just needed to build my balance sheet. So I was buying everything. I wanted the momentum early on is more important than the actual asset that you're buying a lot of times.
Gotcha.
And as long as you're buying rental properties, it's hard to mess up a rental property that you're, that meets the 1% rule. Really is a great rule of thumb. So
Right.
I was buying just any rental property, 12-unit buildings, 24-unit buildings, 60-unit buildings, 18-unit buildings. And I was just buying and organically growing my portfolio, so that way one day I'd have the balance sheet to then go and sponsor loans and sign on loans that are for these bigger complexes. It got me a lot of respect from sellers, from brokers, and from lenders by just having the momentum built up. And so those buildings were great stepping stones to get me to where I am today, but those buildings aren't going to take me to where I'm going. And they're really more of an inhibitor than anything else. They're very management intensive. They're very, use up a lot of brain calories in managing a lot of those properties and asset managing some of those. And so, take a look at the market. It's a very opportunistic time for people who have good, stabilized cash flowing assets. I think what a lot of people don't realize the traditional housing market, where there's, owner occupants and people retail flipping houses versus rental properties, is, although the market's great across the board for everybody, if you have a rental property that's not performing, rental properties aren't valued the same way as a traditional owner-occupied property. And owner-occupied properties valued based on the comparable approach, and really emotionally driven of what somebody's willing to pay for that property based on what is it worth arbitrarily to them.
Right.
An investment property is strictly based on the numbers. It's only based on the operations and the income approach. What's the income minus the expenses equals the NOI. And then there's a multiple of that NOI, that net operating income, that the property's valued at. And so even if the market's ridiculous like it is right now, even if there's a ton of buyers there, out there like there are right now, even if interest rates are as low as they are right now, if a property's not performing, it's not going to get top dollar. Like, they're still going to come in, they're going to buy it for what it's worth, not for what it can be, not in the investment side anyways. And that's good and bad, right? It doesn't have the swings that residential markets might have. Right. Investment properties are more stable. It doesn't have the same highs, but it also doesn't have the same lows. And, even when the market's bad, if you got a great performing property, you can get top dollar for it. When the market's great, though, and you don't have a top performing property, you're not going to get top dollar. So it's just, you got to be really good at operations if you're going to own rental property long-term. And, and obviously, fortunately, we're pretty good at that. We have a great team in place, and all of our assets that we've been selling have been, fairly stabilized. We all dealt with some stuff during COVID, and, had some non-paying tenants and all that kind of jazz that we had to work through. But we're very happy with the sales prices of the properties that we have sold so far. And, I think it's just kind of trimming the fat, refining the operations, taking a step back to make some big leaps forward.
So having said that, I really want to get your thought on deflation and what you see might come down the pipe in that respect, and how it will affect your rents.
Yeah, and so I think there's a few things. And listen, I took some economics classes, but really, you just look at the market and you understand, how people behave, and sometimes you don't understand how they behave. But like, you look at a couple of things that are happening in the market, and if you look at history, the American dollar from 1960 to 1990 was devalued because of inflation occurring and everything, and coming off the gold standard and a lot of all the other stuff. It was devalued by 75%.
Wow.
So it took $4 to buy something that could in 1990 that took $1 to buy it in 1960, right?
Right.
So
Wow.
it's devalued by 75%. And then from 1990 to 2020, based on the war on terror and everything else that happened, and the dot-com bubble burst, and then the housing economic burst, and everything else that happened, it was devalued by another 50%.
Wow.
So $2, it's going to cost you in 2020, $1 in 1990. That would have cost 25 cents in 1960.
Wow.
So, and then they print a third of all dollars ever made in America last year, right?
Yeah.
Over the past 12, 18 months. So like, what does that mean? That means there's a lot more supply of money, which means the value of money is going to come down.
Mhm.
And there's going to be some sort of inflationary period that we will likely go through. Is that going to happen in the next 12 months, 36 months? I don't know from a timing perspective, but it's going to catch up to us. And the only thing that rises with inflation is rents. Rents
Right.
rise the same proportion with inflation, and they go up together. So me, as I'm looking at my portfolio and my ambitions and what I want to do and stuff right now, I don't mind debt. I know a lot of people are either pro debt or anti debt or whatever. Like I think debt, if you know how to use it, is a phenomenal tool.
Right.
And so for me, and especially in commercial real estate, you can get non-recourse debt, which is really exciting. For me, I'm trying to refinance everything right now. Interest rates are super low.
Mhm.
Properties are all stabilized across my portfolio. Almost all of them are. And so we're just refinancing everything into long-term fixed rate debt.
Mhm.
So that way, between 2021 and 2051, as the dollar is devalued even more, I know some people like hey, I want to pay off my property in 15 years. I just want a 15-year mortgage. I'm putting 30-year mortgages on everything.
Right.
One, because I'm young, and two, because I use cheaper dollars in the future to
Sure.
pay down that mortgage that is a fixed mortgage, right? Versus dollars today.
That's
So
right.
it allows me more cash flow today. And economically, it makes way more sense to pay it down over time and to not prepay those loans.
Right.
Because you use cheaper dollars in the future than what those dollars cost today.
So glad that you explained that. There's so many people that don't get that. They
Mhm.
don't understand that having that debt is really so helpful for you in the future.
Yes, and by the way, as your rents do increase over time, so that's only going to increase your margins, because again, you're
Exactly.
paying it with
Your debt's steady, right? And your rents keep on going up.
Right.
future
That's right.
future payments with today's dollars.
Mhm.
And the only thing that I caution people on is don't mortgage them to the hilt, because you still need to have a bit of margin in there.
Sure.
For sure. Yeah.
For the just in case situations that come up and you need to sell the property. You don't want to have to bring cash with you to the closing.
Mhm.
That's the only downside. And 75% or less in most investment properties. Now, I'm talking about single family houses right now, but 75% or less LTV in a property is going to keep you out of most issues, because there was only a few markets, even in 2008, where the values dropped below 25% of what their original values were. So that would still keep you above water.
Mm-hmm. Good stuff.
I had some really good questions to ask you earlier, but Wendy butted in and made me forget them.
Sorry. I'm so sorry. You didn't write them down?
No. So what markets are you in, Tim?
We have property in 12 different markets, mostly in the Southeast. A little bit in the Sun Belt, like kind of in Texas and Oklahoma. We have some stuff in Louisiana, a lot in Georgia, South Carolina, and then we have some stuff in the Midwest because I have a team up there. So Illinois, Ohio, where else? I had some stuff in North Carolina, Florida. Yeah, so I mean, it's pretty much the Southeast though. That's where we like to be.
Us too.
And it's just, yeah, as you guys know, it's more landlord friendly. So you're not dealing with all the tenant compliance and all that garbage, and it doesn't take 9 months or longer to evict a tenant. It takes 30 days. If they don't pay, it's very cut and dry down here. And I'm from Cleveland, Ohio, which when the weather turns, you can't do any work outside for the next 4 to 6 months.
That's
so down here, you can do work year round outside, and you don't get beat up by the snow and the ice and the freezing temperatures and the salt on the roads and all that kind of stuff. So it's just property taxes are a little bit lower down here too. In most areas. Florida's actually pretty expensive. Texas is pretty expensive. Insurance can be a little bit more in certain coastal areas. So you're just kind of weighing out all that stuff. I know a lot of people think grass is always greener. Number one reason I invest in the Southeast because I'm here, right? I live in Charleston. I know the area. I feel comfortable with it and confident with it. And this is where my joint venture partners are and where I have the resources. So really, I just do it because of that. All the other stuff is kind of fringe benefits.
Well, I mean, you're correct in the these are great markets. Even the Midwest that you're in is a good market because they've always been a good rental market in the Midwest. You didn't get the
highs and
lows of the values there. It's a wonderful blue collar communities most of the time. You're not going to get the appreciation that you may get in the Southeast. It just happens to be a hot market right now because of the lower cost of living here. A lot of people are moving here, especially after the pandemic. People are moving to those states where it costs less to live because they have the opportunity to work out of their homes. I wanted to kind of touch on you unloading a few of your, I don't want to call them problem childs, but that one of the matrices that we use is ROE, return on effort.
Yeah.
So if I've got two properties that are making equally amount of money, and one of them is just more of a pain to deal with, that's the one I'm selling because I want that good return on effort. And then the same thing with, your business in general. You have people that you are in business with that helped you get going. Were integral in getting that business off the ground and getting you where you are now, but they just might not be the same fit for where you're going to go. So it's not just portfolio, it's the business in general. And those are tough decisions to make.
And I think they're more important. Like, it's what is the opportunity cost? I was talking to my COO today, who's at a 36 unit apartment building that has like a bunch of HUD contracts and all this. I'm like, we're losing out on millions of dollars right now because you're at this property. Either hire somebody or give the property. Like I would write a check for $500,000 to give the property away to somebody else to come in and buy it at a deep discount. So I never have to think about it again because I'm losing millions for that. You know what I mean? So
I'm your buyer.
Yeah.
You don't have time for that either.
Yeah, that's for sure. That's for sure. I'm curious, as a landlord, have you received any money from the government on tenants that haven't paid? Have you gotten any of that yet?
Yeah. So like in Georgia, our management company is rock stars at it. And usually like our B class and A class areas, still workforce housing, but good areas. We haven't had a lot of tenants that got tripped up because of COVID and their job or anything like that. And we collect 99.7% of all the rents in those properties.
Wow.
In the C class areas, different story, right?
Yeah.
And we're chasing rents. There's a bunch of tenants gaming the system, and it might be like it was 1% the first month, and then it was another 1%, and then all of a sudden it starts snowballing. It's 15, 20% of the tenants are just gaming the system because they know they don't have to pay rent,
right?
And that can mess you up. But the good news is the government did come out with some stuff to help the landlords a little bit if you know how to navigate that. But our management company was trained on how to do that, and they sat down with the tenants, applied with them, and it was something along like it was like 6 months of back rent and 3 months of future rent, or vice versa. It was something along those lines.
Nice.
And we got a lot of people signed up kind of on those programs. I think they're kind of nearing the end right now.
Yeah.
And Fortunately, they lifted the eviction moratorium, so we're having a lot of conversations with people right now. What I don't want is I don't want a mass exodus of tenants, and I don't want to have to turn all these units and outlay all sorts of cash. And although I'm salty with these tenants who did kind of just game the system and didn't pay because they knew they didn't have to pay,
right?
I'm almost like I got to let my ego go and do what's the most economically responsible thing. For me and my tenants, or me and my investors, is we're having conversations with them now and saying, hey, listen, okay, all right, you got one over. Here's the thing. We will not evict you if you catch, we'll try to put some sort of payment plan together or some sort of pay 20% of it and we'll waive the rest of it. And then we'll, and these are for people who didn't get the subsidy assistance. And then as long as you pay rent, you're on a short leash though. If you don't pay rent by the first of the month, there's no, wiggle room at all on this thing. So we're having some of those conversations because I'd rather keep tenants in and just paying rent rather than having to go through the whole process. I mean, I don't think a lot of people realize like, oh, well, if I can keep my utilities down or this down, like, yeah, that's good. The biggest expense for landlords is tenant turnover. And the more you can reduce your turnover, the greater your returns are going to be substantially. And because not only are you not collecting rent, then I got to pay an attorney, then I got to pay court costs, then I got to move their stuff into a storage locker for a little bit if they don't take it all. And then I have to renovate the unit. Then I have to pay a leasing agent to lease it. And then I have to, it's just, there's so much stuff that comes into it, and it sits vacant for another 3 months, So if you can eliminate or reduce that as much as possible, as much and principled in me as I want to be like, no, get the heck out of my properties. I'm not, I'm not doing that right now. I think it's way more responsible to just have a conversation, and just have that dialogue back and forth and try to get them back into a routine of being responsible and paying their payments on time.
Right.
Yeah. Well, being in that business, and most, at least a lot of people are trying to make the landlords look
like the bad guys.
Guy.
Yeah.
It is business, and you have to treat it like a business. But most landlords, property owners, are very compassionate people. They try to work with folks, but they also
have to pay their bills.
The business side to think of, and it's a shame. Some people fall through the cracks. Some people dive through the cracks, and they do it on purpose. And you gotta weed those folks out.
Yeah.
And listen, I'm talking about the ones that are top of mind because they're the biggest problem childs. But really, it's a handful of people across 4,000 units. So overall, we're doing all right. And I don't want to scare anybody from getting into rental properties. It's just, hey, you're a problem solver. The bigger problems you can solve, the more money you're going to make, and the more wealth you can build, the more people you can help, and a lot of other things that can come with it. So expect problems, and the bigger the problem, guess what? That's the bigger the opportunity it is. So don't let it derail you mentally, and just stay on track and just keep on solving more problems.
That's right.
Well, this is why we always tell new investors, you don't want to own a rental property. You don't want to own 2 rental properties. You want to own 10 or 20 rental properties, because you're always going to have a problem. You just, if you only own 1 property and that's the problem, that's not going to do very well.
That's a problem.
If you have a more diversified footprint, then those little problems they're going to be little problems.
They're not going to take you down.
And it's easy to correct those.
We do have one question. It's what is the 1% rule? We know what that is, but can you explain that for somebody who may not know?
Yep, great question. I mean, you learn this a lot of times early on in owning rental property, but or as you're watching podcasts and that kind of stuff, I still use it, and I still think it's a pretty good rule. So 1% is if your monthly rent is $1,000. You would never want to pay more or be all into that rental property for essentially 100 times that, right? You want your monthly rent to be 1% of what you're all into the property for. So if you're all into it for $100,000, you want to be able to yield at least $1,000 a month in rent. If if you can get $1,500 a month in rent, then that means you can pay up to $150,000 per unit, per door, per house, whatever that ends up being, depending on the asset class that you're in. So that's typically, if you can meet that threshold, you can cover your operating expenses, you can cover your debt service, and it'll put some cash flow in your pocket. Obviously, the more above 1% you can get, the better the deal it is. So if you can get 1.5%, which doesn't seem like that much more, 1.5%, that's $1,000 rent. That means you're all into that property for about $65,000 to $67,000. That means you're stepping into a smoking deal, and just little incrementally above 1% makes a big difference. And like, we still use it, right? Like, most of our properties appraise for around 1%, or of what the rent is, right? Or 100x of what the rent is. So if we have a unit that rents for $800 a month, it typically appraises for around $80,000. So we use that as a gauge and a barometer, just kind of a quick metric off the cuff to know what the value is on a building that we're buying or a building that we're selling, or what we think something's going to appraise for.
Awesome.
And that's the beauty of being in the B class within tertiary markets. You get into the A class properties, you're not going to have that 1%. You're going to be paying a lot more. Your cap rates are going to be a lot lower.
Yep.
And then you get into the larger markets, it's just more expensive in those markets. The land costs are higher. Same thing applies. So you're in the right markets, and you're in the right class for that math. Besides that, it's easy to add up.
Right.
Yeah.
Right.
Yeah. It's not standard across the board. If you're in California, or cash flow is cash flow across the board. It's really hard to find a 1% type of a deal in California, right?
Right.
And, or in New York City, or in Boston, or in San Diego, or Dallas, or even so the closer you can get to 1% or above 1%, there's a lot better of a deal. There's also something to be said as you get into like these luxury type of rental properties. If you have something that rents for $3,000 a month, and it's a 1,500 square foot apartment, understand that your operating expenses aren't going to be. To turn on the lights in that unit, it doesn't matter if you're making $500 a month in rent or $3,000 a month in rent. It's the same utility cost. And then, your property taxes are going to be higher or lower based on the cost of the building. But your insurance is going to be about the same, whether you're getting $500 a month in rent or $3,000 a month. So you're going to find that as you get into higher end properties, your expense ratio and the percentage of your expenses that you're let's say of your gross revenue is $100,000. In a B class area, my average expense ratio is about 40%. So if I'm grossing $100,000 a year in revenue, about $40,000 of that's going to go to taxes, insurance, utilities, maintenance, management. And then the other 60% is essentially the net operating income. You got to pay mortgage out of that, and whatever your investor payments are and that kind of stuff. But if you get into more of a luxury type of property, you might have $100,000 of gross income, but your expense ratio might only be 25 or 30%. And so pay attention to some of that kind of stuff, because there's some things that we're looking at actually in not super luxury, but just higher end kind of properties that actually we can make it make sense, because the expense ratio is smaller, so we can pay a little bit more and spend a little bit more on the mortgage, because we're saving a little bit on the expenses.
Right.
So I hope that makes sense.
Absolutely. Absolutely. It's good stuff.
We could talk for another hour.
That's for sure.
We've already gone over almost 10 minutes. Thank you for spending so much time with us.
This has been
awesome content. You do have a coaching business. I do like to tell people that Tim does not do coaching to make money. Tim does coaching to teach people and helpfully add folks to his network that they can do deals with. So
very much so. And that's how it came about. We, just found there were a lot of people who wanted coaching, and we teach them everything. They go and do their own deals. And sometimes they come across deals that are too big for them to get into. And we can bring money, we can bring loan sponsorship, we can bring mentorship. And it allowed us to get into a lot of deals. I've probably around, I don't know, 2,500 of my units come from students that we've joint ventured with and partnered with on different projects.
That's
So,
awesome.
Yeah, it's been really, really powerful. And yeah, it's called commercialempire.com. I appreciate you guys,
Sure.
letting me say that. Commercialempire.com. It's online. It's a virtual event. And it used to be live before COVID. We used to charge $5,000 per person for that. And now it's $500, same content, because it's gone virtual. We have no overhead anymore. So we do it a few times a year. And then, yeah, we do a little bit of, we got a mastermind group stuff too. But come out to that. That's kind of the first step into how do you scale into buying a lot of rental property and into apartments and commercial real estate. And we like to take the complex, convoluted, mystical, almost out of reach type stuff, thoughts that we all have about commercial real estate early on, and just get them all out of the way, break it down to a third grade level, very elementary of how to work through deals, how do we raise money, how we source off market deals, and how you can asset manage those and build real long-term wealth there. So
your next one, when is your next one, or are you just signed up for it and it's recorded and ready to go?
Yeah, the next live, well, when you sign up, you get access to a past recording immediately, so you can at least kind of go through that. And then our next one, I think, is October 7 and 8 is the live. So
awesome.
Yeah, you sign up, you get access to the recordings immediately. You can watch those over the course of the next 30 days, and then you can plug into the live event, which has discussion panels, and my team's there, and we're answering Q&A live and all sorts of stuff for a couple of days.
And do you get a copy of the recorded one that you're involved in as well?
Yep.
Okay.
Yep.
Awesome. That's great. And what's the best way for somebody to reach you if they wanted to reach you directly?
Social media. Hit me up on Facebook or Instagram. I'm very active on both of those. And just shoot me a direct message on either of those. And if anybody has questions, I'm happy to help out, point you in the right direction, be a resource, or at least connect you with a resource.
Awesome. Good stuff.
Absolutely.
I'm going to sign up.
Thank you.
I appreciate you guys. Next time you're in Charleston, you gotta hit me up. I'd love to take you guys out to eat and just kind of hang out and spend some more time together. So thank you for having me. I respect the heck out of you guys, and I appreciate your friendship too.
Thank you.
Again, thank you so much for joining us. I can't wait to get back down to Charleston. The last time we were down, Wendy and I were down there, all the Christmas decorations are up in downtown, and I was walking around in shorts and flip-flops.
That was cool.
You can't beat Charleston.
Yeah, we like that. That was nice.
All right. Well, anyway, thank you so much. And folks, thanks again for joining us on the Passive Accredited Investor Show. I said it correctly this time. We are Carolina Capital Management. We are lenders in the Southeast for real estate investors. If you are interested in borrowing money, go to carolinahardmoney.com and click on the Apply Now tab. If you're a passive investor looking for passive returns, then click on the Accredited Investor tab. Don't forget to like, share, subscribe, hit the bell, and sign up with Wednesdays with Wendy.
That's right.
Y'all have a great rest of the week.
We'll see you next week.
Jonathan is going to do this solo next week because Wendy and I have travels.
Bigger names on the other line.
That's right. Take care.